Hello and good morning, folks. Welcome back to Almus Market Mornings, your daily dose of global financial update with me, Shikhar Garg. And we begin another week after a surprising week last week that we have had. Now, England might be rejoicing the T20 World Cup win, but Friday data doesn't give much of a room for them. UK GDP fell 0.2% last quarter, ending the growth streak of previous 5 quarters being 0.4% smaller than it was at the end of 2019. Now, even the European Commission was found warning this Friday of a possible recession in the fourth quarter. Now, JK, we've had both the UK and the European Commission warning and showing, recessionary signs, while the markets were found rejoicing in the previous week on the lower CPI data backdrop. So, is it too early for us to rejoice, or there has to be some caution, or these data should be taken with some pinch of, salt? What's your take?
Yeah, Shikhar, I don't think everything has changed, but definitely the main concern, which was on the inflation, that has given some comfort to the markets. Uh, Geopolitics, again, there are mixed indications. There are reports that uh, you know U.S. administration is asking some officials to be in touch with Russia as well as with Ukraine for resuming peace talks. Uh, US president is also meeting the Chinese premier on the sidelines of G20 in Indonesia. So people are watching with interest. A lot of negatives have been in the prices, both in the stocks, bonds, and also in the currencies. So in fact, dollar has become a talking point again now, and that's more for a slump in the value of the currency compared to the unabated rise that we had seen for several months. Mixed reading on the Fed message earlier and also the CPI coming lower than expected have obviously served as triggers, but there have been other developments also which is quite positive. There have been hawkish statements from Eurozone officials like Nigel and Schnabel, who are calling for strong ECB action because inflation is still very high. Let's also remember that inflation in the US has shown some moderation, but in the Eurozone, inflation has not shown any such signs so far. So we must still have a 0.75 hike by ECB when they meet next. Then the easing of some of the COVID restrictions by Chinese authorities over the last week, particularly on the travel quarantine period, and also recategorizing the areas of COVID into high, medium, and low instead of only high and low earlier. So many of these things are actually giving some comfort to the investors. So the latest bout of weakness in the dollar was led by the Chinese one. Obviously, yen has also followed because yen has seen a slump. Rather, the dollar yen has seen a slump of more than 8% from its peak, initially aided by some intervention, and later on the fundamental developments in the US and also the slump in US yields, which has triggered this. And mostly gone unnoticed is the fall of 8% in USD CHF from above 1.01 and now back near 93.93. So dollar has had a big slump, and this I would put it down partly to fundamental developments, partly to the positioning in the market, which was obviously one-sided for several months. Let's remember that the dollar's rally started in May 2021 when euro had 1.2350 and dollar index was near 0.89. Yes, the one more development over the weekend has been the much less impressive performance by the Republican Party in the elections, while the fate of the House is yet to be decided because the California state counting is still going on. It will take some more time, but the Senate has now gone in favor of the Democrats. Even if, the worst case scenario would be 50-50, since they have a casting vote from vice president, I think the Senate will be in their control. Now that means there will be less of a gridlock and more of a upper hand for Democrats to push through their agenda. and maybe that is slightly positive for the dollar or negative for other currencies because they would like to hold on to the inflation fighting, and Powell probably will continue strongly with this inflation fighting strategy, and notwithstanding that CPI came lower. In fact, he would like to see more evidence of CPI coming down, of which we'll have evidence later in the month with core PCE prices and also how the economy is performing. We had the Michigan survey last week where the consumer sentiment dropped quite a bit. But again, this sentiment data or the survey was conducted before the CPI data came, so it can read differently in the coming days, as well as the inflation expectations are higher. That also can be influenced by the actual inflation number, which was released later. So I think there are mixed indications for the dollar after having seen such a big move on the downside. I personally feel that we can have a bit of a retracement for the dollar after having been sold for such a long time. Just a medium-term outlook from my side on dollar is that it is rallied for three main reasons: higher rates in the US, better performance of the economy, and safe haven flows due to geopolitics. Huge short positions created in other currencies due to above factors seem to have undergone some unwinding in the last few days, with CPI serving as a trigger. However, for further move in this direction, we need to see other economies improving as well as easing of geopolitical tensions, both of which are still quite unchanged. Hence, I feel near-term prospects for a further dollar fall would be quite limited. Also, the gold prices, which have seen a rally, but it has been a hesitant rally as investors are still weighing between higher yields from bonds versus zero yielding metal, and the previous slumps from such rallies are still not forgotten by investors. Technically, however, we do see the setup quite constructive for further rise in the gold prices, but needs more softer data on the trigger. Yeah, of the data, we will have enough triggers this week. Retail sales from the US, final reading on the inflation from the Eurozone, UK employment and inflation numbers. Finally, to top it all, we have the UK budget, which is looking for raising a lot of resources to fill the fiscal hole that they are staring at. So UK is definitely going to have a long drawn recession because taxes will rise and there will be spending cuts. But it may be seen as a medium-term positive because the fiscal consolidation for the country, could be good, particularly increasing the credibility of the investors in UK. So that's the picture overall. US stocks were closed, but still the global stock index, went up by 2% on Friday, keeping up the recent rise in the stocks. Of course, we need more triggers to see whether the bearishness has ended or not. As far as the rupee is concerned, yes, we had a stream of gap openings for 3-4 days, and that has actually created a bearishness on the USD INR, notwithstanding that India's fundamentals have not seen any major change. Oil prices are still near 100. Although we do import a lot of oil now from Russia at discounts, and the trade deficit, which is still high till last month, and we should have the new number for October very soon. India CPI expected to moderate below 7% once again, and WPI, both of which will be announced today. WPI to fall to 8.7% from 10.7%. We did have industrial production data on Friday, which was at 3.1% plus versus minus 0.7% last month. And this is actually come from improvement in the capital goods sector, and that gives some hope of capex cycle actually changing. We are already having the reports that credit of tech has been very strong, and so that sounds good for India. But yes, as far as the external front is concerned, oil inflows and the deficits will play a big part technically, and also the positioning wise. I feel the USD INR will face a very strong support near about 80 because all the importers and dollar payables, dollar liability holders will be latching on to levels around these levels. And I don't think they will get greedy to much lower levels, keeping in mind that they have to cover those payables at these dollar, which is lower by 3% from the top. Exporters and investors obviously having missed out on higher levels with many gaps happening due to movement in offshore markets, will latch on to levels above 81.30, 50. So define near term range between 80 and 81.5, waiting for more fundamental developments.
Okay, JK, wonderful. And yes, folks, the issues or the concerns when it comes to macro sides have not yet been done with. And as JK mentioned, even though we have seen quite a bit of a correction for USD against all the other currencies, it may have to be so that the other economies will have to start improving, or there has to be some change in geopolitics for them to continue this kind of rally that they are having against the dollar, as the geopolitics, the lower performance when it comes to economy and the safe haven was the reason for dollar to move up so higher. Another update was the fact that there would be still some more evidence that the US central bank would be wanting to see before on the CPI front before having any actual actions towards the rate hike. But all said and done, we have the Indian CPI, which would be released today, and it is likely to moderate below 7%, while the strong credit offtake and capex cycle look to be positive for the Indian economy. So, all in all, we are having some sort of a mixed market, and folks, we'll continue to bring in all the sorts of updates that we encounter for you to manage your risk as prudently as you can. That's it for today. We shall come back again tomorrow with another round of updates. Thank you so much for listening.